Bringing it all together. What closing really means. Chapter 21 pulls together everything that happens after a buyer and seller sign a purchase contract and moves it toward the final moment when money and title change hands. You learn that closing is not just one event, but a coordinated process that includes putting the deal into escrow, verifying title, arranging and disclosing the buyer's financing, prorating and paying expenses, signing and recording documents, reporting the sale to the IRS, and in some cases, withholding tax for foreign sellers. At the heart of this process is escrow. Escrow is the use of a neutral third party, the escrow or closing agent, to hold money and documents and only release them when all conditions of the contract are met. During the sale, the buyer deposits funds, earnest money, down payment, and loan proceeds, and the seller deposits a signed deed. Once all contractual conditions are satisfied, the escrow agent releases the deed to the buyer and the funds to the seller. In many finance transactions, escrow continues after closing through impound accounts for property taxes and hazard insurance, forming the TI in the buyer's PITI payment: principal, interest, taxes, insurance. This protects the lender's collateral and helps the borrower budget for large annual or semi-annual bills. The closing event: time, place, and process. The closing event is where everything is reconciled. The buyer pays the balance of the purchase price, the lender funds the loan, and the seller receives net proceeds after payoff of liens and payment of closing costs. Before that date, many pre-closing tasks have to be completed: title search, appraisal, inspection, repairs, underwriting approval, and final walkthrough. You learn that the sale contract sets the closing date and often makes time of the essence. That phrase means dates in the contract are strict deadlines, not suggestions. If a party misses a deadline, the other party should use the contract's cure provisions rather than simply waiting and hoping. Some examples from the chapter show why dates matter. Choosing a closing date right before a weekend or holiday can complicate funding, recording, and cure periods. A careful agent checks the calendar, talks with the lender and title company, and avoids trap dates such as the last day of the month on a Friday with a Monday holiday. The location of closing can be the title company, the escrow office, a law office, or another agreed site. Some parties sign with a mobile notary or via remote online notarization if allowed by state law. The key is that all required signatures are obtained and documents are delivered to the closing agent in time to fund and record. The closing process itself involves verifying that each party has performed what the contract required. For the seller, that usually means providing marketable title, backed by a title commitment or policy, satisfying liens and recording releases, signing the deed, and delivering any required affidavits. For the buyer, it means delivering funds, signing loan documents, and confirming inspections and repairs are acceptable. Once everything balances, the agent records the deed and related documents and disperses the funds. Title and title insurance, protecting ownership and collateral. A central piece of closing is confirming that the seller is delivering marketable title. The title company searches public records for liens, encumbrances, easements, restrictions, judgments, tax issues, and other clouds on title. It issues a commitment that lists requirements and exceptions. The seller is usually expected to clear bad items, such as unpaid liens, before or at closing. The buyer or lender may also require a survey and a final walkthrough to confirm boundaries, improvements, and property condition. To protect against hidden defects and errors, lenders and buyers rely on title insurance. You learn that title insurance is not like most insurance that covers future events. Instead, it indemnifies against covered defects from the past that affect ownership rights. The two primary policies are the owner's policy, which protects the buyer and their heirs up to the purchase price, and the lender's policy, which protects the lender up to the loan amount. If a covered claim arises, such as an undisclosed lien or a forged deed in the chain of title, the title insurer may pay the claim, cure the defect, or defend the insured in court, and may later pursue the responsible party through subrogation. This chapter also reinforced that owners' and lenders' policies may have different insured amounts, duration, exceptions, and endorsements. In many markets, including Arizona, the buyer typically pays for the lender's policy, and the seller or buyer may negotiate who pays for the owner's policy. RESPI, TRI-D, and Consumer Disclosures. The Real Estate Settlement Procedures Act, RESPI, is designed to protect consumers by requiring clear disclosures and prohibiting kickbacks that inflate settlement costs. RESPI applies to many residential, federally related mortgage loans. You saw that RESPA and TILA, Truth in Lending Act, were integrated under the TRI-D rule into a simpler disclosure framework, replacing older forms like the Good Faith Estimate and HUD-1 Settlement Statement. Under TRID, the lender must provide the CFPB, your Home Loan Toolkit booklet, shortly after application. Issue a loan estimate, LE, within 3 business days of a completed loan application, outlining key loan terms and estimated closing costs. Provide a closing disclosure, CD, at least 3 specific business days before loan consummation, giving the borrower time to review final terms and costs. TRI-D also introduced tolerance levels for changes between the loan estimate and closing disclosure. Some fees can change freely. Some are subject to a combined 10% tolerance, and some zero tolerance charges cannot increase at all except in defined circumstances. If tolerances are exceeded, the creditor must cure the overage, usually by issuing a refund within a set period. The chapter walked through the H-25 closing disclosure form in detail. Page 1 summarizes loan terms, projected payments, and costs at closing. Page 2 itemizes loan costs and other costs, distinguishing who pays what and when. Page 3 compares the cash to close with the initial loan estimate and summarizes the borrower's and seller's sides of the transaction. Page 4 explains other loan features, such as assumptions, late fees, negative amortization, partial payments, and escrow details. Page 5 shows loan calculations, APR, total interest percentage, other disclosures, and contact information. Understanding how to read this form is essential for explaining closing numbers to buyers and sellers. Financial settlement, debits, credits, and prorations. The closing statement is essentially a detailed financial scorecard. It converts all the negotiated terms into debits, amounts each party must pay, and credits, amounts each party will receive. For the buyer, debits typically include the purchase price, loan fees, prepaid interest, prepaids for taxes and insurance, and various closing costs. Credits include earnest money already paid, the loan amount, and any seller or lender credits. The difference between total debits and credits is the amount the buyer must bring to closing. For the seller, credits generally include the sale price and any prorated items owed to them, such as taxes or prepaid rents for post-closing periods. Debits include payoff of existing loans, commissions, title charges, transfer taxes, and the seller's share of prorated items owed to the buyer. The difference between the seller's credits and debits is the cash they will receive at closing. You also learned about non-prorated items, which belong solely to one party, such as a flat attorney fee, a survey, or a specific recording charge, and prorated items, which are shared between buyer and seller. Prorated items might be property taxes, HOA dues, rents, hazard insurance premiums, or other expenses or incomes that straddle the closing date. The key concept is that the party who benefits from or is responsible for a period pays their share. Computing prorations, 12-month draws 30-day versus 365-day methods. The chapter introduced 2 main methods for computing prorations: the 12-month 30-day method, often called the 360-30 method, and the 365-day method. Under the 12-month or 30-day method, you assume a 360-day year with 30 days per month. You divide annual amounts by 12 to get a monthly rate, and then by 30 to get a daily rate. You then multiply by the seller's or buyer's days of ownership to compute shares. This method is commonly used for prorating mortgage interest and some insurance premiums. Under the 365-day method, you use the actual number of days in the year and month. Annual amounts are divided by 365 or 366 in a leap year to get a daily rate. Monthly prorations divide by actual days in that month. This method can be used for taxes and other items where precision matters and local custom supports it. Usually, the seller owns the property up to and including the day of closing unless the contract states otherwise. So that day is allocated to the seller. The proration method and which party gets the closing date should be spelled out in the contract or follow local custom. Taxes at closing and property tax examples. You also examined how transfer taxes, documentary stamps, and mortgage taxes appear on the closing statement where applicable. Some states charge a tax based on the sale price or the amount of debt. These charges can be shown as debits to either the buyer or seller, depending on state law and negotiation. More importantly, for prorations, you learned that property taxes are often paid in arrears and must be divided between buyer and seller. In Arizona, property taxes are billed in two halves, due on specific dates in October and March, with late dates following. At closing, the parties prorate taxes based on the annual amount and the closing date. If the seller has already paid the full year, the buyer reimburses the seller for the buyer's share via a credit to the seller and a debit to the buyer. If none or only part of the taxes have been paid, a portion of the seller's share may be charged at closing, with funds placed in escrow. The chapter also gave income tax examples, showing how the IRS treats prorated property taxes, even if one party does not physically pay their share under the contract. The IRS may still treat them as having paid that portion for deduction purposes. This reinforces the importance of drafting contracts that clearly state how taxes will be prorated and ensuring that closing statements reflect those arrangements. Closing cost case study, from numbers to net proceeds. To make the numbers real, the chapter presented a case study with sellers, Lawrence and Sandy, and buyers, Bill and Dillis, in a conventional loan purchase. You saw how the broker's commission is calculated as a percentage of the sale price and charged as a debit to the seller. Real estate taxes were prorated using the 360 divided by 30-day method, based on months and days of the seller's ownership in the year of sale. The seller's unpaid mortgage interest for days in the closing month was computed and debited to the seller because mortgage interest is paid in arrears. The buyer's loan origination fee and points were calculated as percentages of the loan amount and debited to the buyer as closing costs. The buyer's escrow account was funded with several months of tax and insurance reserves, also debited to the buyer at closing. The buyer's prepaid interest was computed from the day after closing to the end of the month. This avoids a partial interest surprise later and sets up the first full payment, due a month after that period ends. Finally, you learned a practical rule of thumb. The first mortgage payment is generally due on the first day of the second month after closing, which effectively gives the buyer a short period of occupancy before the first full payment is due. Reporting and recording. The legal footprint of a sale. The last part of the chapter addressed reporting requirements and recording. For reporting, the Tax Reform Act of 1986 requires many real estate sales to be reported to the IRS on forms like 1099-S by a designated real estate broker, which can be a broker, settlement agent, lender, or title company. Brokerages also issue information returns for commissions paid to co-brokers and independent contractor agents. When a foreign seller is involved, FIRPTA, Foreign Investment in Real Property Tax Act, requires the buyer, usually, to withhold a percentage of the gross sales price to ensure that the foreign seller's U.S. tax obligations are met. There are exceptions and ways to apply for reduced withholding, but the key is that FIRPTE must be addressed early in the transaction and cannot be ignored. Finally, you saw how recording deeds, deeds of trust or mortgages, releases, and other real estate documents in the county land records provides constructive notice to the world of ownership and lien rights. The recorder's office does not guarantee the truth of each document. It ensures that qualifying documents are accepted, indexed, and preserved in order. Priority disputes over competing claims are decided using state rules, such as race, notice, or race notice statutes, all of which reward prompt recording and protect good faith purchasers who rely on the public record. Review Summary. Chapter 21 took you from the concept of escrow to the final recording and reporting steps that legally close a transaction. You learned that escrow is the neutral mechanism that safely transfers money and title in stages rather than all at once. That the closing event consolidates financing, title, and contractual obligations into a single settlement, guided by the closing agent and documented through forms like the closing disclosure. That RESPA and TRID require clear, timely disclosures and limit how much certain fees can change, giving buyers time to compare and understand their loans. That the financial settlement hinges on correctly assigning debits and credits and apportioning shared items through prorations, using standard methods and clear contract language. That taxes, insurance, loan fees, escrow reserves, and prepaid interest all interact to determine the buyer's cash to close and the seller's net proceeds. That federal reporting rules, FIRPTA, and local recording systems ensure that sales are visible to the government for tax purposes and to the public for ownership and lien notice. By mastering these pieces, you move from simply selling houses to managing a complete transaction from contract to closing with confidence and competency. Discussion: A buyer says, "All I care about is my interest rate. Why do I need to care about the closing disclosure?" How would you answer in light of what you learned in Chapter 21? Suggested answer: you could explain that while interest rate is important, the closing disclosure shows the full cost of the loan and transaction, including fees, escrow reserves, mortgage insurance, and total monthly payments. It allows the buyer to verify that charges match the loan estimate within legal tolerances and to see how much cash they must bring to closing. Without reviewing the CD, a buyer could be surprised by higher fees, incorrect prorations, or unfavorable terms that go beyond just the interest rate. A seller asks why they have to pay a portion of the year's property tax at closing if the bill is not even due yet. How do you use the concept of proration to explain this? Suggested answer: you might explain that property taxes are tied to periods of ownership, not just due dates. Even though the bill may not be due until later, the seller owned and benefited from the property during part of the tax year, so they owe their share of the year's taxes. The buyer will actually pay the bill in arrears later, but the closing statement reimburses the buyer for the seller's share by prorating taxes through the closing date. This keeps the division fair. Each party pays taxes for the time they own the property. A foreign seller wants to skip FIRPTA withholding because they promise to file a U.S. tax return later. What is your role as an agent, and what should you recommend? Suggested answer: as an agent, you cannot waive federal law, and you do not provide tax advice. You explain that FIRPTA is mandatory when applicable, that the buyer is usually the withholding agent, and that failure to withhold can expose parties to significant liability. You would immediately involve the settlement agent or title company and recommend that the seller speak with a cross-border tax professional about options, such as applying for a reduced withholding certificate. The transaction should not proceed without a clear FIRPTA plan. A buyer wants to know why they must fund reserves for taxes and insurance into an escrow account instead of paying those bills directly. How does Chapter 21 help you answer that question? Suggested answer: you could explain that many lenders require an escrow or impound account as a condition of the loan to protect their collateral. By collecting a portion of taxes and insurance with each monthly mortgage payment, the lender can make sure those critical bills are paid on time. This reduces the risk of tax liens or uninsured losses that could damage the property's value. From the buyer's perspective, it also helps spread large annual expenses into predictable monthly amounts, even though it raises the total monthly payment. Closing remarks. Chapter 21 showed you that closing is where law, math, finance, and professionalism all meet. You saw how escrow protects both sides, how disclosures make loan costs transparent, how debits, credits, and prorations turn a contract into real numbers, and how reporting and recording give transactions a permanent legal footprint. As you move forward in your real estate career, your value will be measured not only by your ability to find properties and negotiate offers, but also by your skill in guiding clients through these final, technical steps without confusion or surprise. This chapter gives you the foundation to read settlement statements with confidence, anticipate issues before they derail a closing, and work smoothly with title, escrow, and lenders to get transactions successfully across the finish line.